Bismillah ar-Rahman ar-Rahim. Assalamu alaikum. Peace be upon you. Thank you for returning to the CIFA series on Islamic finance. In today's segment, we're going to be covering the general differences between Islamic and conventional banks. Now that we have reviewed riba nasi'a, we understand that Islamic finance has a specific business proposition. The basic model of a traditional bank, however, is distinct. A traditional bank borrows money from its depositors and lends the same money to business or personal borrowers. The bank intermediates between a broad group of depositors and a smaller group of borrowers. The broad group of savers and safekeepers expect the bank to return to them their capital plus interest without considering the outcome of what happens when the bank lends the money to others. Likewise, when the bank lends the money to others, it's not worried about future developments in their personal financial life or their business performance. It believes that its claim on principal and interest is fixed no matter what happens to the poor customer. In credit analysis, of course, banks try to avoid the bad risk or to mitigate or reduce those risks. We'll find that Islamic banking is quite different. This concept, though, of modern intermediation is important to consider in the sense that without it, we would never have had the Industrial Revolution and the many modern developments of industry, technology that we've enjoyed over the last 250 years. Modern intermediation requires an interest rate. The amount paid to savers and the amount paid by borrowers needs to create a difference that will be the profit to the bank and cover the bank's operations. That difference is what we would call the spread or margin. When we look at this entire picture, we essentially looked at the depositors seeking interest in a manner that is consistent with our definition of riba nasi'a, and we see the bank claiming interest, again, in that same manner that represents riba nasi'a. So the modern example of a conventional bank is going to be problematic for us to comply with Sharia. The tools for Islamic banking will fall into two main categories: customer funds and customer placements. That sounds semantic, but it will prove to be meaningful. Customer funds, in turn, will either be loans or deposits that share risk. The former are normally checking or current accounts, and these will never be allowed to earn interest. In some countries, current accounts at conventional banks earn interest. This will not be the case with any Islamic bank. The risk-sharing deposits will have returns that depend upon the performance of the bank. And depending on the bank's location, such deposits may actually be exposed to the risk of loss of capital. Unlike conventional savings and time deposits, the typical deposit at an Islamic bank is linked not to the fluctuation of interest rates, but to the performance of the bank. Curiously, the feature that may make an Islamic bank more risky than a conventional bank, this actually may crystallize losses at the time of a bank's difficulties and reduce systemic risk. Customer placements at most Islamic banks are either in the form of selling or leasing, and a few bolder Islamic banks may make equity placements into the operations of their clients. The use of sale and leasing contracts helps an Islamic bank to mitigate risk closer to the simple credit risk of conventional banks. But in some countries, Islamic banks are allowed to hold inventories in anticipation of future sales. These banks are sometimes able to enjoy exceptional performance, or they may bear losses directly related to the cost of holding inventory. The relatively small number of Islamic banks using equity placements is a feature of modern banking regulation. The global banking model can absorb risk-sharing deposits and credit through selling and leasing. But equity risk is normally the province of investment banks or merchants, i.e. those who take equity risk in inventory. As a result, some countries and some analysts feel that Islamic banking is an incorrect characterization or application, and they wish that Islamic banking would be Islamic investment banking. Both the financial crisis of 2008 and the nature of modern banking regulation mean that Islamic banking, with its clear differences from conventional banking, will always be a challenge to implement. Thank you for joining us today in our discussion of the difference between Islamic banking and conventional banking as part of the CIFA series on Islamic finance. We look forward to you joining us in a future segment.